Markets are betting that the Bank of Canada is going to lower interest rates for the second time this week, after inflation data came in lower than expected at 2.7%. And the question is, will it happen? And what does that mean for interest rates going forward, especially if you have a mortgage? Because one of the biggest risks that the Bank of Canada has to face right now is the mortgage renewal risk that is coming along with keeping interest rates high. But before we get into all the details, my name is Nolan Matthias, and if you want the latest Canadian financial and real estate news, this is the place for you. So do me a favor, hit the subscribe button and hit the like button if you found this video useful. Oh, and by the way, if you still want to get my book, Mortgage Secrets, you can go to mortgagesecrets.ca and get it completely for free. All you have to do is pay the shipping and handling. Okay, so let's get into it. Let's discuss what's going on with the Bank of Canada and the expectations for the upcoming rate announcement. Now, make sure you hit that subscribe button because later on this week, I'm going to be doing a State of the Canadian Real Estate and Mortgage Market live stream, where I'm going to discuss everything you need to know if you're thinking about jumping into the real estate market, if you're shopping for a mortgage, and if you are renewing a mortgage. So you don't want to miss that one. It's going to be a longer than normal video, but it is going to have some seriously valuable information in it. I'm going to go into a lot more depth than I normally do in a 12 to 15-minute video. But with respect to what's happening now in the Canadian real estate market, in the Canadian mortgage market, and with the Bank of Canada, it seems that things are about to get interesting. So I'm going to jump into the news here as we tend to do and show you exactly what's going on early in the week leading up to the market update, the Bank of Canada rate change that is expected to happen on Wednesday. So the first thing we need to talk about is inflation. Then we're going to talk a little bit about the predictions, and then I'm going to show you exactly what's happening with bond yields, and keep in mind that those typically affect fixed rates and are a little bit of a leading indicator to what might happen with respect to interest rates. So first, let's talk about inflation. Inflation falls to 2.7% in June, driven by slower growth in gas prices. Now, there were a lot of things that happened. Some things went up, some things went down, as always happens with CPI data. But there was some really interesting stuff here on gas prices because normally in the spring and in the early summer, when people start to vacation and drive to other areas in order to take advantage of the cottage life or the beach life, typically gas prices tend to go up. But that isn't happening this year. And you'll see in a second relative to what happened last year. And if we take a look at this, this is a report from BNN, and I'm just going to hit the highlights here. So first, economists are saying an unexpected dip in the national inflation rate bodes well for the prospects of the Bank of Canada making a second straight cut to its benchmark interest rates. And this is after inflation fell to 2.7%, down from 2.9% in May, which, by the way, was higher than expected and had some people worrying that interest rates weren't going to start to come down as much as previously expected. But what it is clearly being shown now, or what is clearly being shown now, is that 2.9% was a blip on the radar and things kind of came back into line in June. That doesn't mean that in July and August and September, they won't start to come back up. But what it does show is that the trend in general is downward with respect to inflation, which is good because that means essentially lower interest rates at some point. Now, this is largely being attributed to the deceleration of slower year-over-year gas prices. And the one thing to keep in mind here, though, is that one thing doesn't necessarily have a massive impact. It can have a slight impact. And lower prices for durable goods are also contributing to the overall slowdown, falling 1.8% year over year in the month, following a 0.8% decline in May. But what's interesting here is that a lot of the previous month's spending, the increase in spending, has turned out to be just a blip on the radar, as the disinflation trend shows that demand in the economy continues to be under pressure. And look no further than grocery prices, which rose by 2.1% year over year in June. We've all seen this when you're buying groceries right now. And this is up from May when it increased 1.5%. So in other words, food prices are starting to go up at a greater level, and they're continuing to go up even though the gas prices fell. Now, if gas prices start to go up, that could completely change the whole outlook for inflation here. And in addition to that, shelter spending was also softer than usual, with rent seeing a 0.1% increase, the smallest in nearly 2 years. Obviously, shelter costs have been a leading contributor to higher inflation over the last couple of years. And even though this is showing signs of improvement, many economists are noting that it is going to continue to be a grind to get down to that 2% level. So then the question becomes, do they lower interest rates? Do they try to get things going in the economy at the risk of spurring on inflation? Do they leave interest rates the same? Well, I'll show you in a second what the bets are with respect to what they're actually going to do. So let's take a look at those market bets. And there's two articles I'm going to go to here. The first is from BNN. The second is from Reuters. It's Reuters. Somebody corrected me on that recently because sometimes I just say things wrong. Market bets on second Bank of Canada interest rate coming this week. And here are the highlights from this article. Expectations that the bank will lower its overnight lending rate when it makes its scheduled announcement Wednesday have been high since last week's release of the Stats Canada inflation report. The inflation rating was less than 2.8% that the markets had been expecting, which of course means that this is potentially going to give the Bank of Canada some bandwidth to lower interest rates. Now, there's not only the inflation data that is showing that the Bank of Canada should probably be reducing interest rates, but there also is unemployment data. The most recent data on the Canadian job market shows the economy stalling in June, losing 1,400 jobs, while the unemployment rate rose to 6.4% from 6.2% in May. The June result was the highest reading for the unemployment rate since January of 2022, another indication that raises the odds of the Bank of Canada lowering rates this week. Because here's the thing, even though inflation is the primary mechanism that the Bank of Canada looks at when it comes to reducing interest rates, there is a significant potential issue if unemployment jumps up too high. So now that you've got combined inflation reduction and you've got an increase in unemployment, well, that creates a scenario where the Bank of Canada is looking at those two factors going, hey, we've got a little bit of room in inflation. Maybe we should take a look at this unemployment number because it's getting worse. And if that starts to get bad, it can go up very, very quickly. So they will probably take the opportunity to lower interest rates in order to hopefully save the unemployment numbers. Now, some pundits, some economists here are suggesting that if the rate cut does happen, this should shake up the Canadian real estate market because when we saw the first cut in June, nothing really happened. All the buyers that were expected to come to market didn't actually show up. But what showed up was a whole bunch of sellers that were expecting the buyers to show up, and there was an increase in the number of listings. And this has actually led to significant softness in the Canadian real estate market. And a survey conducted by CPA Canada and BDO Debt Solutions conducted shortly after the June rate cut found that half of Canadians say interest rate hikes have negatively impacted their debt loads, with 7 out of 10 saying the June cut had no impact on their financial outlook. So what this means is that potentially, a rate cut could see some buyers come to the real estate market. And keep in mind that Jarvis here, this guy works for a real estate company, so that's what he's hoping for. You have to keep in mind the source of the information at any given time. But there's also the chance that given that people see lower interest rates as not impacting their financial situation, well, that could still mean that buyers remain on the sidelines. So the thing here is that with respect to the Canadian real estate market, only time is going to tell what is going to happen with buyers and sellers. And yes, we're seeing softness in many markets across Canada, and there is a high probability we will continue to see that softness. Now, then the question becomes from there, though, what is the expectation with respect to interest rates going forward? So I pulled out this one from Reuters, and the Bank of Canada is expected to cut rates this week as inflation slows. There's some really interesting stuff in here, primarily the survey of economists. So a Reuters poll released on Friday showed nearly 3/4 of economists surveyed from July 16th to July 19th, which was the end of last week, expected a rate cut in the policy rate to 4.5% this week. So 75% of economists are saying this is probably going to happen. But what's really interesting is that financial markets, so the people who are trading on interest rates, are seeing almost a 93% chance of a rate cut this week and a total of 75 basis point drops in borrowing costs this year. So, in other words, the market is expecting that not only is there going to be a rate cut in July, but there's going to be at least another one by the end of the year. Now, one last thing to note buried deep in this article is they were talking about growth in the economy. And what some economists are suggesting is that the growth in the economy isn't so much growth as it is population increase related. So, in other words, our productivity isn't increasing. It's just we have more people, and that's creating growth somewhat artificially. And the immigration stuff here is somewhat backstopping the economy, but obviously that's creating a significant amount of upward pressure on real estate, which we all know is having a significant impact on affordability. So just something to keep in mind here. Now, I wanted to show you the Canadian 5-year, 3-year, and 2-year bond yields because this gives an indication of kind of where we were and where we're going. And what you can see here is that all of the bond yields today are significantly lower than they were at this time last year. And we've seen this reflected in fixed mortgage rates as they've started to come down. And the market, the bond market, is very much pricing the future reductions in interest rates into bond pricing, and that's lowering bond yields. And this is by virtue lowering 5-year fixed rates. Now, what's interesting is we haven't seen any major reductions in 5-year fixed rates in the last couple of weeks, but the bond yields have gone down, meaning that there is some room for banks to move on their 5-year fixed pricing. So expect that sometime next week, after the Bank of Canada makes its decision, there's probably going to be some rate cuts on those 5-year fixed and those 3-year fixed and those 2-year fixed mortgages. And when they do, make sure you're tuned to this channel to see exactly what they are. So then the question is, what does this all mean for consumers? Well, if you're looking at buying a home in the next little while, it definitely means that there are going to be both lowered prices given the softness in the market and some lower interest rates on the future horizon. Now, that being said, when you're choosing between variable and fixed, even though it looks like interest rates are coming down, keep in mind that variable rates are priced significantly higher than fixed rates right now. So if you have the opportunity to get a mortgage at 0.75% lower on a fixed rate and you think, hey, interest rates are going to come down by 0.75%, so I should probably take the variable, keep in mind that they actually have to go down further than that to make up for all the time that you're going to spend paying a higher interest rate on that variable rate mortgage. So you don't just need them to come back down to where fixed rate mortgages are priced now, you need them to come down further. So you have to keep that in mind, and you have to look at that when you're looking at your risk profile. Now, when it comes to choosing between a fixed and a variable rate mortgage, don't be like all those people in 2020 and 2021 who made really bad mortgage decisions because they just watched a 13-minute video and decided that, hey, somebody said a variable rate was the right thing to get, and didn't really dig deep into the differences between different types of variable rates, the different types of lenders, the B lenders, so B is for bank, the bank lenders that had mortgage products that were not as good as what they could have gotten elsewhere, and found themselves in a seriously crappy situation as a result. If you're going to be choosing a mortgage in the next 3 to 6 months or the next 12 months, you don't just need a good broker, you need a great broker to help you understand everything that comes along with those mortgage choices. And if you need a great broker, my team at Mortgage 360 can definitely help you. They'll help you understand your risk tolerances, the difference between the different types of products, and make sure no stone is left unturned when it comes time to get your mortgage. Oh, and if you want to see more about what's going on in the Canadian real estate market and with respect to interest rates, make sure you check out this video right here.